I'm focusing more on Bitcoin. Everything from the U.S. regulations is that we might get this ETF and Bitcoin's away from the fray. That's the point I'm making is Bitcoin needs to outperform risk assets on a risk-adjusted basis. If it's not, it's telling us something has changed and something is wrong. And what's changed in Bitcoin? Volatility is the lowest ever. Why? It's in the mainstream now. Cash and carry. That's the point thing we pointed out years ago. The minute you can trade futures in Bitto and are about that, hedge funds are all over that. When you can get free 10% return risk adjusted and you can hedge in futures, it's done. So to me, Bitcoin is a new world now. It's into the mainstream. We're going to get those ETFs, but it's going to trade more like equities, and it's not going to have anywhere near the performance we've had in the past.
In the preceding week, the Federal Reserve announced a shift in its stance, no longer anticipating a recession in the United States. However, Joe Davis, Vanguard's prominent economist, offers a contrasting viewpoint. He foresees an increase in unemployment surpassing 4% within the upcoming year, and he considers this metric as indicative of a recession. Davis underscores that even though the projected job losses are relatively modest, a consensus is emerging among several financial institutions that unemployment will rise above 4% over the next 12 months. This rise is a consequence of the Federal Reserve's forceful interest rate hikes influencing the labor market. In a recent podcast, Davis engaged with Bloomberg's What Goes Up series, revealing that while these employment changes may mitigate wage growth and contribute to the desired 2% inflation target set by the Fed, they could also undermine prospects for a gentle economic slowdown when surging prices eventually cool. While the U.S. is not currently on a path to recession, Davis suggests that labor market vulnerabilities are pivotal to achieving a successful transition from a 3% trend inflation rate down to the 2% target. The discussion includes insights from Mike McGlone, senior commodity strategist for Bloomberg Intelligence, and Lyn Alden, a respected macroeconomist and investor, as they delve into the global financial macro landscape and share their perspectives on recession predictions. Embark on this enlightening experience by tuning into the dialogue of these esteemed individuals.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
One thing worth pointing out is that central banks rarely forecast recessions. The fact that they did earlier was kind of unusual because central banks often don't want to be like self-fulfilling prophecy. Also, kind of putting a recession there is kind of a political statement in a way. And so they often don't really forecast a recession, kind of like how we look at the Congressional Budget Office and their forecasts, they also never assume a recession. They look out 10 years and they just give this like smoothed, outlook. And so I don't think we should really go by Fed analysis of recessions because you're inherently dealing with a semi-political organization. So I think we have to keep an eye on indicators, and those are mixed. I mean, I think some of them are pointing towards recession. Most real figures have decelerated. When you look at like the Conference Board leading indicator, that's very weak. And I think the key thing that's kind of holding it up is the fact that we're still running very large deficits for this part in the cycle. We're basically running the types of recession, like deficits you'd normally see in the deep part of recession before we're even in one. And it's not as impactful of a stimulus as, say, stimulus checks or child care tax credits, but it is leaking out into the economy in various ways, and that's kind of propping up at least the service sector and some other areas as well.
We have to point it's actually the opposite. It's what they say versus what they do. You just look at the New York Fed probability of recession from the yield curve. It's the highest since 1982. So, I mean, and like Lyn said, yes, they're political. You can't expect Treasury Secretary Yellen to say, yeah, we're going to have a big recession. But and I knew Dave would laugh because this is one of those things you have to say, yeah, thank you. Ignore what you say, watch what you do. The Fed has tightened the most ever from zero. Not just that, central banks. So we have to hope that those rules don't apply anymore. But I'll let Lyn focus on the economics. The key thing I just got from our morning meeting was from our economics team. It's household balance sheets are great, but the view is we're going to have a significant slowdown. Just look at the Fed. That's what their indicators point out. And people are calling for a victory way too early. And that's what I love. It is July. I mean, come on. We know what happens in markets, and Dave knows what happens in markets. I remember in the trading pits, it was almost every July and August, my boss would look next to me and say, Mike, volumes are killing us, because volume goes down, volatility drops, and people go on vacations. And then you get to August, September, and reality hits. And that's why this fall could be similar to the Octobers we've had in past. But the bottom line from my standpoint, let's focus on what really matters for me. Is you look at the key sectors I watch, commodities and cryptos, they are clearly tilting towards significant economic slowdown. Let's start with commodities. The Bloomberg Industrial Metals Index is down about 10% this year. Gold is up about 10%. That's rare that happens without a significant recession. And we see every single piece of data out of China is tilting towards, I would say, disappointment. And what's going to change that? Sure, they need they need stimulus. Everybody's depending on that. We heard that back in January when they're going to reopen. And then you look at cryptos. The Bloomberg Galaxy Crypto Index on a one-year basis is basically unchanged. That's horrible when the Nasdaq's up 20% on a one-year basis. So look at the way I look at it is this biggest sign of liquidity, the biggest indicator, the most significant new technology ever. AI has been around for 50 years. Some of us have remember reading about this in undergrad, which for me was 40 years ago, is still showing there's a problem. And then, so what's the most significant crypto? Bitcoin. Yes, the bullishness we saw a month ago was really my red flag that this is a serious problem. And that is that everybody's calling for victory way too early, despite the fact the number one basis of all markets is liquidity, and the Fed is still taking that away. Not just the Fed, the ECB, the Bank of England, and China's scrambling to catch up. So I look at this as good luck. And hopefully the stock market will keep lifting all tides, lifting all boats. But the bottom line is anybody who's getting, you got to be careful long risk assets when you can get minimal 1 year, 5.25% in US T-bill. The average return in the stock market over time is 8 to 9%. I might say sometimes you just have to look over to McGlone and say, yeah, I was dumb. I did what, suggests what McGlone says, and stick with T-bills and relax and lay low and get out of risk assets.
Since March 2022, the central bank has undertaken a significant interest rate hike, elevating rates from 0 to over 5%. This move aimed to curb escalating inflation. However, the central bank also committed to a data-independent strategy for tightening in the previous week. Inflation has subsequently receded from 4-decade highs to a more moderate 3%. Remarkably, job figures and the US GDP have continued to climb despite the rapid ascent of borrowing costs. Keiko, a cryptocurrency market data provider, reveals that Bitcoin's correlation with the S&P 500 index has hit a 2-year nadir, standing at a mere 3%. This highlights Bitcoin's increasing autonomy from conventional financial systems, prompting speculation that this divergence could potentially fuel a surge in its price to new record highs. Now, let's return to the video as Lyn and McGlone delve into the equity market, exploring the implications of Bitcoin's correlation for the global economy.
One of the concerns I'm watching, because there are two directions that can go bad for equities. One is that if economic data continues to deteriorate and point towards recession, that's generally not good for equities. And then two, if you get a reemergence of some energy inflation, we're seeing signs. Crude oil's been firming up a little bit. Gasoline's been at like year highs. The past year you had the SPR drawdowns. You had Iran get more of their oil to market. There's been a number of supply and demand changes, and if this starts firming up, then you take away that disinflationary component that's been there for the past year, and if you start putting that into the market, that has implications for long bonds, that has implications for Fed policy, which then can trickle through into equity valuation. And we have to see. So the past several months, the Treasury has been really focusing on T-bill issuance. They've been funding themselves at what is ironically the most expensive part of the curve right now, because that's the best for liquidity. That's how they're able to get liquidity out of the reverse repo facility. Some of the estimates are that they might shift more towards coupon issuance later this year, and that could have implications for the shape of the yield curve and for overall liquidity. Like, where is that going to be funded? Because coupons are not going to be funded with reverse repo, and so that's a potentially a different liquidity environment. So I do think that there are significant risks later this year, and I don't know if they're going to say transfer over to Bitcoin or not, or if Bitcoin's going to do more like a kind of trade more like gold, where it doesn't really care about, say, corporate earnings in a way that equities do. It very much tends to be a liquidity play more often than not. So I think that's one of the key things to watch is that equities have two sides of the area to worry about, where some of the other asset classes, I think are a little bit cleaner.
I'll give you two key facts about crude oil I wrote in my latest outlook. The latest estimates of motor fuel demand, unleaded gasoline in this country, is about 5% below where it was in July 2019, right before COVID. 5% down. Okay, so economies, everything's coming back. The world's changed, yet that demand is still slipping. This is from the world's largest economy. It's been the best indicator of crude oil collapsing since the peak in the bear market. There's been a bear market in crude oil since 2008. And another key factor, Bloomberg New Energy Finance points out, total sales of EVs now running around 15% of new car sales. That was about 3% right before COVID. What are those trajectories? So I love when people point out, yes, there's risks of crude oil. We had a massive pump. We had that worse. We had a situation very similar to when Saddam Hussein invaded Kuwait, and that put in a peak in crude oil that lasted, I think it was for almost 20 years, but it went from 40 and it dropped almost as low as 11 6 years later. We're in a similar situation. So I point out crude oil is one of the most deflationary commodities. It's the most elastic commodities, and it has the higher price cure. So key thing is, if, as Lyn pointed out, if we do get higher CPI and things like this from this latest little spike in unleaded gas, exactly. What does that do for the Fed? What does that do for the macro? It's the lose-lose I'm worried about. Now we've had this bounce and everything, and it's been wonderful. I didn't think it'd go this far, but it's also the fact you need to point out in the big picture.
The International Monetary Fund has raised its global economic growth projection for 2023 to 3%, up from the earlier estimate of 2.8% in April. While this adjustment is moderate, it remains below historical standards, with the forecast for 2023 increased by 0.2 percentage points from the April report. Advanced economies are the primary drivers of the growth decline due to weaker manufacturing and offsetting factors in services activity. The IMF's World Economic Outlook also addresses inflation, predicting a decrease from 8.7% in 2022 to 6.8% in 2023 and 5.2% in 2024. However, it cautions about potential risks that could lead to higher inflation, such as geopolitical tensions and extreme weather events triggering restrictive monetary policies. The report also discusses the possibility of renewed financial sector turbulence as central banks tighten policies. Despite challenges, the IMF suggests optimistic scenarios, including a faster reduction in inflation, which could ease the need for stringent monetary policy. The report underscores central banks' roles in maintaining price stability, strengthening financial supervision, and mitigating risks for sustained disinflation and financial stability. Feel free to share your thoughts on these macroeconomic insights in the comments section below. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.